All right, today we're diving headfirst into what feels like a perfect storm shaking up the global markets. We're talking about currency chaos in Japan, some serious trade tensions brewing in North America, and political gridlock right here in the US. I know, it's a lot, but stick with me because by the end of this, you'll not only get what's driving the mayhem, but you'll know how to think about it like a pro. Hey everyone, welcome to ValueVest Daily. I'm really glad you're here. We're about to unpack some of the biggest, hairiest risks facing investors right now. But here's the deal. We're not just going to list the problems. We're going to cut through all that noise to find the real signals and focus on a clear, strategic, long-term perspective.
So these are the headlines just lighting up our screens, right? And each one on its own is enough to cause some anxiety. But when they all hit together on January 25th, 2026, you get this perfect storm of market mayhem. It's so easy to get swept up in this kind of chaos, but our job today is not to react to the noise. It's to understand the signals that are hidden inside of it.
And look, this isn't just a gut feeling. The data is screaming it. Just take a look at the VIX. People call it the market's fear index for a good reason. It tracks what investors think volatility is going to look like. And as you can see, it has shot up this week. We went from a pretty calm 12 last week to a much more nervous 18. I mean, that's a 50% jump. That shows you just how real the anxiety is out there. And that anxiety, it's hitting the market where it counts. Even before the opening bell, S&P futures are already pointing down 0.75%. This is what we call a risk-off mood. It basically means investors are pumping the brakes, right? They're pulling back from stocks and looking for somewhere safer to park their money. And it's in moments exactly like this that a clear head is your best asset. So this brings us to the most important point. While all the headlines are screaming chaos, a disciplined value investor, well, they see something totally different. They see opportunity. You see, widespread fear can make people sell things irrationally, pushing the price of great companies way below what they're actually worth. Our job is to see past that short-term panic and find the long-term potential. So here's how we're going to break it all down. First, we'll tackle the currency crisis in Japan. Then, we'll jump over to the trade threats between the US and Canada. And finally, we'll look at the potential government shutdown here at home. Once we've got a handle on each piece, we'll pull it all together into a solid, coherent strategy. Okay, first up, let's jump right into what's happening with the Japanese yen. And trust me, this isn't some far-off issue. What happens here could send ripples through global bond markets and even affect the profits of companies you own. Man, this situation is moving fast. The yen took a nosedive, getting dangerously close to that 160 per dollar mark. That got the prime minister to come out with a sharp warning against speculators, which made the currency bounce back. Now, all this craziness is really being fueled by one big thing. While everyone else has been hiking interest rates, the Bank of Japan has kept theirs near zero. That makes holding yen, well, not very attractive. So now, the entire market is just holding its breath, waiting to see if Japan is going to step in and start buying up their own currency. And if you're thinking, hey, this sounds kind of familiar, well, you're right. We have seen this movie before. Way back in '98 during the Asian financial crisis, Japan jumped in. And much more recently, in 2022, they spent a staggering 9 trillion yen, that's more than 60 billion US dollars, to prop up the currency. So these verbal warnings we're hearing now, that's step one. It's a signal to the markets that they mean business. History tells us it can work for a bit, but it doesn't always fix the deeper issues. Okay, so what does this all mean for us? How do we actually use this information? Let's break it down. When the yen gets weaker, you'd think that's great for exporters, right? But this much volatility just creates uncertainty and can actually hurt their stocks. So the play here might be to look for solid, undervalued companies that are focused on Japan's own internal market. Now, what if they intervene? Well, that might calm the currency down, but it could shake up the bond market. That's a huge reminder of why we need to diversify. And if that bond chaos spills over, companies with a ton of debt are going to feel the pain. The lesson? Zero in on businesses with rock-solid, low-debt balance sheets. All right, let's hop across the Pacific now, from Asia to right here in North America, because a whole different kind of risk is brewing. Trade tensions between the US and our neighbors to the north, Canada. So the headline here is just, wow. A threat of 100% tariffs on Canadian goods. And it's all tied to Canada limiting its trade deals with China, with a specific focus on a new policy allowing more Chinese-made electric vehicles in. Now, that threat definitely spooked the Toronto Stock Exchange. But here's the weird part. The Canadian dollar actually got stronger. And that's because the US dollar itself has been slipping amid all this global uncertainty, which kind of makes other currencies look stronger just by comparison. Trade wars are absolutely nothing new, and history gives us some pretty stark warnings. Back in the 1930s, the Smoot-Hawley tariffs are famous for helping turn a bad recession into the Great Depression. And more recently, remember the 2018 steel tariffs? They caused huge disruptions in supply chains. The stuff we're hearing today, it sounds a whole lot like that, reminding us these threats can have very real and often very painful consequences. And this, right here, brings us back to one of the most famous and powerful ideas in value investing, straight from Warren Buffett. Be greedy when others are fearful. Trade wars, man, they generate so much fear, especially for industries like car manufacturing or energy. But for a disciplined investor, that fear can create amazing buying opportunities in solid companies that just get caught in the crossfire. The real trick is having the guts to see the real value when everyone else is just seeing panic. And that brings us to the third piece of this crazy puzzle, a risk that's brewing right here at home. The threat of a U.S. government shutdown, where political games in Washington could slam the brakes on the whole economy. So here's the deal. The whole thing is getting stuck on funding for Homeland Security and ICE after a really tragic shooting in Minneapolis. Senator Schumer is vowing strong opposition, and we've got a classic political deadlock. The deadline is this Friday, and at this point, a partial shutdown is looking more and more likely. That means federal services get disrupted, payments get delayed, and the economy gets another big dose of uncertainty it really doesn't need. And once again, if we look back, we can see a pretty clear pattern emerge. Shutdowns are definitely disruptive. The longest one, back in 2018, shaved a bit off GDP each week it went on. The 2013 shutdown caused a market dip, but you know what happened next? A sharp rebound. The lesson here is pretty clear. Brace for some short-term pain and volatility, but historically, the market bounces back pretty quickly once the politicians in Washington figure it out. So, think of this as your game plan for getting through a shutdown. In the first phase, when they're just arguing and volatility is spiking, you play defense. You check on your companies, make sure their balance sheets are strong. Then, if a shutdown actually happens and everyone else is running for cover, you get ready for the recovery. And then comes the resolution. The market almost always has what they call a relief rally, and that's when you go on offense, buying up great assets that got unfairly beaten down by all the fear. All right, so we've got currency risk out of Japan, trade tensions in our own backyard, and political gridlock in Washington. They feel like three separate storms, right? But what happens when they all start to merge? How on earth do you connect all these dots and build one single resilient strategy? And this is where the rubber meets the road. We're going to bring it all together. This is not about making panicked moves. It's about taking those timeless, proven principles of value investing and applying them to the challenges of today's market so you have a clear plan. Here are 5 steps you can take. First, rebalance. Just check your portfolio. Does your mix of stocks and bonds still make sense for you? Second, monitor your hedges. If you have anything in place to protect against things like currency swings, just make sure it's working as you expect. Third, stay grounded in value. Use tools like a discounted cash flow or DCF analysis. It sounds complicated, but it's really just a way to figure out what a company is actually worth based on its future potential, ignoring all the daily noise. Fourth, and this is huge, demand a margin of safety. This is a core idea in value investing. You only buy a business when its price is way below what your homework says it's truly worth. And finally, stress test everything. Ask yourself the tough what-if questions. What if these tariffs actually happen? What if the shutdown lasts for a month? Know how your portfolio will react. A classic 60-40 portfolio, 60% in stocks from around the world, 40% in bonds, is a perfect example of a setup designed for times like these. Think of it this way. The stocks are your engine for growth over the long haul. The bonds, they're your shock absorbers. A lot of the time, when fear sends stocks down, investors run to the safety of high-quality bonds, which pushes their prices up. This gives you stability, and just as important, it gives you the dry powder to buy more of those great companies when they go on sale. And that really gets to the heart of it. Like the investing legend Jeremy Grantham says, the number one goal in crazy times is just to survive. The trick isn't about predicting every little twist and turn. It's about building a portfolio and a mindset that's robust enough to get you through the short-term chaos so you're still in the game to win in the long term. Okay, before we wrap up, I have to give you these super important legal stuff. Please remember, everything we talked about today is for educational purposes only. We're here to help you think through these things, not to tell you what to do with your money. This is not financial or tax advice, so please always talk to a qualified professional before you make any decisions. All right, so if this breakdown helped you make a little more sense of the madness out there, do me a favor and hit that like button. and subscribe so you don't miss our next deep dive. Sharing this is the best way to help other investors stay informed too. And I've got a question for you. What's your biggest market worry right now? And one more thing, please put in a comment if you want us to deep dive into any specific high-risk/reward opportunities. Thanks for watching.